Hey everybody, Derek Nelson here, founder and partner of the Polaris Financial Network and author of the book, The Financial Foundation System, which is available on Amazon. Make sure you get your copy today. Also, please like, comment, and share. I want to hear some feedback. And if you're watching this on YouTube, hit that subscribe button for me, okay? So, what I want to just get into briefly today is real quick, term insurance. Term insurance is a way to protect our loved ones, our income, right? So I would take out a term policy maybe while the kids are in the house, protect, pay off the mortgage, cover some income, make sure expenses are paid for a period of time, right? You could definitely get the best bang for your buck with term insurance. With that said, there is a term. So when I say there's a term, typically you hear 10-year term, 20-year term, maybe 30-year term. But in general, what terms are is a level for that period of time. So if I were to take out a term policy for 20 years, my death benefit and my payment should remain the same for 20 years. Now, once that term is up, it will be based on my age. So for example, I'm 45 years old. So if I took out a 20-year term today, let's say it was $50 a month, and my term for 20 years, that payment will remain $50 a month. But in the 21st year, the insurance company has the right, and probably will, raise my premiums based on my age. Not my medical, my age. So that $50 could become $70 for the next year, and then the year after that, it could become $105, and then ultimately it becomes to the point where it's unaffordable. So what I like about term is that on the front end, it's the least expensive initially, but over time it does get more expensive. I kind of liken it to renting an apartment, right? An apartment that costs you $1,000 in rent a month today might be $1,500 a few years from now. So that's kind of what term is. You lock in a price and a death benefit for a period of time, and then that could all change. But what I also want to talk about is it could be confusing out there. We see TV commercials, we may get solicitations, and I want to clear the air. So what I did was I ran $300,000 benefit on yours truly, based on my birthday, on 20 years. I'm going to start first with something called accidental death. Accidental death is an inexpensive policy. It's a way to boost some death benefit just in case for a fraction of the cost. But if you pass away for any health reasons, it does not pay out. So I ran something called accidental death, and for $300,000, that policy would cost me $39.82 per month. That's the least expensive. Why? Because basically I have to die a certain way. Has to be an accident, automobile crash, something lands on my head and kills me. Who knows? These things could happen, right? Then there are basically three types of term policies out there that are the most common. There's your basic to the bones term, non-convertible, meaning that in 10, 15 years, if you decide, or even 2 years from now, if you decide you want to do something permanent, like a whole life or a universal life, you don't have that option to convert this policy. Then there's convertible insurance, which does give you the option and the right to convert. You have that privilege. Then there's something called simplified issue. Simplified issue is generally, it could be different types of insurance, but for this conversation, we're talking about term insurance, is gonna be your most expensive because why? They're not having you get any medical done. They're not asking you as many questions. So let's start off with the non-convertible term. Again, this is a $300,000 death benefit, 20-year term. I just did normal health, non-smoker. I don't smoke, so we're going to do non-smoker rates. And the reason why I didn't do like preferred health is because on the simplified issue, that's generally not an option. So on a non-convertible term policy for 20 years, my monthly premiums would be $70.76. A convertible policy would be $74.39 a month. and a simplified issue 20-year term would be $152.19 a month. That is $77.80 higher than my convertible term. So you just want to you want to understand, you want to be aware. A lot of mortgage protection type of policies are a simplified issue policy. So there's no blood or urine, there's not a lot of medical questions, but just know that you're probably going to pay at least double of what you would typically pay on a fully underwritten policy for the same death benefit, for the same time period, for the same age. So I just want you to understand that a little more clearly. And what I'm going to get into on my next video will be permanent life insurance and how those work over time. And we'll get into that. So make sure you subscribe, share this out so you can get alerted to the next video. And I look forward to talking to you once again. Have a great one. Bye-bye.